The US Treasury is pumping record short-term debt into the market. Sounds remote, right? But what exactly is happening here? And more importantly, how could it end up hitting your mortgage, your business loan, and the timing of your retirement plan? Because these shifts in liquidity don't just rattle Wall Street, they can quietly rewrite the math on when and how securely you get to retire. When you hear that the US Treasury is issuing record amounts of short term debt right now, it might sound abstract, but it is actually pretty simple if you think of the government like a massive household or business. The Treasury runs a huge cash account, basically, its checking account called the Treasury General Account or TGA. This is where it pays everything from Social Security to federal salaries to Medicare bills. Typically, this account holds between 500 to 700 billion dollars. That cushion ensures the government can keep running even if something unexpected happens, like a political standoff or a sudden recession. Earlier this year, Congress was deadlocked over the debt ceiling. Because of that, the Treasury couldn't legally borrow more money. It had to pay the bills using only its existing cash, draining the TGA down to about $300 billion, roughly half of its usual safety buffer. Now that Congress has finally lifted the debt ceiling, the Treasury is rushing to rebuild its cash reserves. It plans to bring the TGA back to $500 billion by the end of July and around $850 billion by September. The quickest way to do this is to flood the market with short-term treasuries, T-bills, that mature in just weeks or months. Think of the entire financial system like a giant pool of water. That's liquidity. By selling more T-bills, the Treasury is effectively drawing water out of that pool and into its own tank. This is fine at first. There is plenty of liquidity sitting around, about $180 billion in the Fed's overnight reverse repo program and a $3.3 trillion in bank reserves. But as the Treasury keeps pulling, those water levels drop. Or picture it this way. Imagine you're at a grand banquet. In the center of the hall stands a giant barrel of punch. That's liquidity in the market. Everyone has their own cup. Some scoop punch to buy stocks, others to buy long-term bonds or to fund real estate deals. Then a VIP guest arrives, the Treasury, carrying massive containers. They start drawing huge amount of punch directly from the barrel, offering a safe 4% return. Many guests willingly pour out what they already scooped to hand it over for that stable yield. But as the Treasury hauls more punch away, the remaining punch becomes more scarce and precious. Anyone still trying to fill their cup to buy stocks or long bonds now has to pay a higher price, demanding higher yields. Or they simply accept that with less punch sloshing around. The market will swing more wildly. That's how reduced liquidity pushes up volatility and borrowing costs. If the reverse repo pool dries up, the system turns to bank reserves. But no one knows exactly how low reserves can go before markets get jittery. We've seen this movie before. In 2019, when reserves fell below an invisible line, overnight lending rates suddenly spiked. The Fed had to step in with emergency cash injections. This matters to families and business because it pushes up the cost of borrowing across the board. Mortgages stay expensive, business loans become pricier, investment markets grow more sensitive to any shocks. Essentially, as the Treasury vacuums liquidity out of the system, everyone else ends up paying more to borrow. The recently passed Big Beautiful Bill is about the long term picture, though. It signals that the US will likely keep running large deficits, which means even more borrowing ahead. Investors see a government that's urgently issuing short term debt to refill its checking account while also signaling it will rely on future borrowing to fund tax cuts and spending. The recently passed Big Beautiful Bill is about the long term picture, though. It signals that the US will likely keep running large deficits, which means even more borrowing ahead. Investors see a government that's urgently issuing short term debt to refill its checking account, while also signaling it will rely on future borrowing to fund tax cuts and spending. So markets start pricing in higher long term rates too. The Treasury is quickly issuing short term debt, like maxing out new credit lines. to restore its cash buffer. This stabilizes the government in the near term. But by draining liquidity out of the market, it risks pushing up costs for everyone else. For households, that means mortgages and car loans stay elevated. For businesses, it means more expensive capital. And for investors, it means markets more exposed to sudden shocks. This is exactly why so many affluent families in the US right now set up living trusts, they buy insurance policies and annuities. They're not chasing the last bit of yield. They're locking in certainty in the system that's increasingly volatile and expensive to borrow in. To sum it up, the US Treasury flooding the market with short term debt is a lot like a company that had its credit lines frozen for months and it's now urgently opening new short term credit cards to refill its accounts. It reduces immediate risk for the Treasury, but also pulls liquidity out of the broader market. That means, in order for the rest of the economy to keep running smoothly, it may have to offer higher interest rates to attract money back. And ultimately, the ones footing the bill are the families and the businesses that still need to borrow, invest, and operate in this environment.